Hello investors, welcome to Simpli Stocks. The Nifty IT index has corrected by more than 35% from its peak, and if we look at the individual IT businesses, some have corrected even more. And this drawdown in the IT sector is even more problematic because the price correction has happened over the last 1.5 years. Before that, we also saw a long time correction starting after mid 2021. As you can see here, the index itself has been largely sideways for several years. IT companies are facing multiple problems at the same time, from AI to demand slowdown. In today's video, we will discuss IT businesses. I have kept the video short intentionally because there is not much to say or more to say. Many investors are invested in IT businesses, so I thought of making this video. And as all IT majors have already announced their results, the data is in front of you. So hopefully this helps you to take a call on these businesses. In this video, we will look at overall management commentary and the future outlook of this sector. And understanding management commentary is very important because these are the people who are actually running the businesses and working within the sector, not news channels or say any so-called market expert who is telling you to buy the dip. The management has the most information about what is really happening in the sector. So with that, let's get started. If you look at this table, you will see that the results for all IT majors have been quite weak. In the IT space, companies are evaluated on the basis of constant currency growth. Like we often hear that dollar or euro has gotten stronger against the rupee. So technically that gives IT companies a temporary benefit. But when evaluating results, we assume that what if the currency had not moved? This is to see what then the actual sales growth would have been, because that gives you the real picture of how much the company's sales and profits are actually growing. So on quarter basis, from January to March months, these companies have shown minus 3.5 to 1.5% degrowth or growth. Looking at the full year performance, the top line is around minus 2.5% to 3% year-on-year growth or degrowth. As you can see, there is essentially no growth in the sector. That is why even though these stocks are now trading at PE multiples of 10 or 15, they are not undervalued. This is a classic value trap. Growth has disappeared, so the market is derating them. I don't know how many people are still buying these just because the PE looks low. They don't realize that there has been a foundational shift in the sector. And from here, problems are only going to increase. I have been warning everyone in our Simpli Stocks community about the IT majors for a long time now. And I have also discussed these updates with you on the channel as well. So the seeds of this heavy correction were sown a long time ago. Retail investors could have easily avoided this drawdown or trap if they had taken decisions based on data and results. Instead, retail investors do what they do. They often invest based on stories and long-term slogans. A 35 to 40% correction in an entire sector is a very big deal. Sectors can go through very long periods of consolidation. So don't believe in stories. And the best example of this is the real estate sector. You will see that after the 2007-2008 correction, the sector stayed stagnant for 10 to 15 years. Even today, Nifty reality trades below its peak, which it touched back then. So multi-decadal lows happen. You have to understand that you cannot invest just by looking at PE, or you cannot invest just by assuming that this is the bottom and I should buy it. Now, a humble request just before moving forward, if you are liking this video so far, do give me a thumbs up. Also, you can subscribe to our channel Simpli Stocks, where we bring multiple such videos every week. I know I keep saying this repeatedly and you don't listen, but if you support us, I'll be able to bring more such high quality research to you for free. So do like this video, and yes, don't forget to subscribe to our channel. Anyways, coming back to our discussion, I was saying that these problems are not new. For the past 2 to 3 years, you must have heard yourself that slowdown in the US and Europe is coming or about to come or whatnot. companies were laying off employees and cutting IT budgets. This means growth in IT companies had already stopped 2 to 3 years ago. What is surprising is that even at that time, many people were advising to buy IT stocks by ignoring all the facts. From well-known fund managers to even few finance influencers, people were promoting IT stocks using narratives like consistent compounders, long-term growth, AI opportunities, and whatnot. But since then, IT stocks have only and only corrected. That is why I kept saying, don't blindly do the bottom fishing in any random business, because when you are bottom fishing, or let us say you are buying a stock just because it has fallen, without understanding how serious the underlying problem is, then it also backfires, because you don't know whether the problem in the sector will take 6 months or 6 years to resolve. And this slowdown could not have been predicted in terms of duration. That is the first thing. The entire IT sector is even now going through a consolidation phase. Major markets like Canada, US, and Europe all are facing issues. There is also vendor consolidation happening. Large companies are acquiring smaller ones, or they are merging. So this leads to overlapping in IT systems, and then IT budgets are further cut wherever there is such overlapping. And if you listen to management commentary from companies like TCS, Wipro, HCL, Tech Mahindra, or Infosys, none of them are talking about growth. They themselves don't know whether they will get enough orders next year, or if a business will decline further. And you will be surprised to know that Wipro has even guided for -2% to 0% growth. So in the best case, revenue will remain flat, and in the worst case, it can decline. So this just shows us how weak the demand environment is. And in such a scenario, how will the sector generate returns for investors? Just think for yourself. And as I mentioned, the problems are just beginning. They are beginning because many companies are still working on old contracts they won a while ago. When ChatGPT arrived in late 2020, there was a lot of noise and disbelief. People thought that it might be just a short-term fad or whatever. But since then, AI has become a lot mainstream. So now everyone knows that it is here to stay. And there is a high chance that as new contracts are signed or old ones are renewed, the contract sizes will be revised downward. We call this AI deflation. IT companies will face deflation in new contracts because of AI. So that is the broader premise, that contract sizes will get smaller. Currently, companies are using AI to increase efficiency, speed up project launches, and fix old tech debt. But once their infrastructure is optimized, deflation is inevitable. You cannot ignore that. And I have given this example of AI deflation on our channel again and again. So suppose an IT company used to bill a client for 5 or 10 engineers. With AI, that work which took 5 engineers can now be done only by 2. So obviously, when the client gets to know this, or basically everyone knows that in the end your costs are coming down, so the client will also push back because your costs have gone down, and they will also want that contract gets revised. Secondly, let's say if you don't lower your price, then when it is about to be, let us say, renewed, then your competitor will come into the picture and they will underbid you. So, and that is already happening. Tata Elxsi's management mentioned that they were very surprised by how some competitors were bidding on certain orders. They were putting very, very low bid, and they wondered if those competitors were using AI to be able to quote such low prices, and the management did not have the answer themselves. So pricing pressure is definitely going to come. There is no growth. IT budgets are flat across industries like healthcare, manufacturing, telecom, media, and on top of that, now finally AI driven deflation. So competition from here is only going to increase because a large number of companies are going to fight for that smaller pie. And please do not take AI deflation lightly at all. 3 weeks ago, you would know Oracle laid off 12,000 employees in India. While researching for this video, I saw that Meta or Facebook has fired 10% of its workforce, or about 8,000 people. So these are AI-led decisions. Companies simply don't need as many IT engineers as before. So when costs drop, contract values will follow. Here, one counter argument that comes that AI services revenue will help to offset AI deflation, as companies like TCS and Wipro are getting AI related contracts. But you have to understand there that this is just part of the sector now. This is not something extraordinary. Providing AI solutions is now basic requirement in the industry. Whether you are doing digital transformation or creating data processes or building platforms, AI is essential. Work that earlier took 24 months now has to be delivered in 12 to 14 months. Plus, the funniest thing is that when IT companies are mentioning agentic AI, people get impressed, but the paradox is that the AI agents being built will essentially replace your own staff. In the end, you are just moving the work of your engineers to agentic AI. So the sector is entering a very, very uncertain phase. Even management teams themselves are not sure how much worse things can get. Everyone is extremely cautious and conservative, and this is not the time to bottom fish in this sector or space. There are much better opportunities in the market. I will say please go out and check out those businesses instead. And if you have already invested or you bought that dip, you should acknowledge that it may have been a mistake. Lastly, if you found this video helpful, please hit the like button, and yes, also subscribe to our channel. This will help me to know if you are liking such videos or not. So don't forget to like and also subscribe. I'll see you in the next video. Happy investing.